Thank you for joining us. This is a continuation of our series about educational forums that we provide for people in the marketplace and CEOs all over the place. So this time we're going to be talking about CEO money matters. And the kind of forum that we talk about is, are your numbers ready for the Shark Tank, or are you just chum in the water? Now, if you think back about Shark Tank, there's a couple of things that universally come up in Shark Tank, right? So when somebody's on Shark Tank, what are some of the biggest things that the sharks always bust the entrepreneur on? So if y'all want to chime in and have some suggestions, that's great. Well, I will kind of tip the bar here, tip the scale, because generally when those deals go bad, sometimes it's the economics, but it's stunning how often the sharks go, you really don't know your numbers. You don't know what your numbers are telling you about your own business. And what does successful numbers really look like? So that's why we really started this deal, because so often we believe here at New Life that your numbers is a universal rule. Your numbers are screaming at you as far as actions to take or what is the health profile of your business. In fact, we have a different saying that says, your numbers and your metrics, they should create an appropriate level of anxiety for you and your staff to take action. The problem is we don't understand our numbers well enough. So when you're thinking about your numbers, the other thing that I want you to think about is what really drives your numbers. And I'll tell you, your financials, they are nothing more than a historical reflection of your people, decisions, behaviors, processes, and systems. It's really those five things. And yes, you have a great strategy. I'm sure you have a great operating plan for the upcoming year. But whatever your numbers are now, if you don't understand how your people, their decisions and behaviors affect those numbers, then how can you really change your numbers? Because implicitly, to change your numbers, you have to change your people, their decisions, their behaviors, their processes, and their systems. We also believe here at New Life that a role of a CFO, a big role of the CFO, is not just a financial leader, but the chief financial education officer. A big part of that role is to help your people understand that when they change their behaviors, what is the impact, what is the risk, and what should be the expected outcomes. I'm a huge believer that whenever you're making a change, I recommend that you first start off by defining, what does success look like, right? And then also says, what does failure look like? Because then you have a better expectation about what the outcomes are going to be, and you can measure yourself. You know, and I kind of said this. So within the CFO, we not only educate, but then we help to align those changes in behaviors and decisions and processes to which ones are most aligned with your strategy, and then which ones are most aligned to drive cash and ROI. So chief education officer, and then sometimes chief prioritization officer. Now, some of y'all may contest that, because certainly the CEO is driving the bus, or the metaphor that we've used before is the CEO is always the pilot, but your CFO is the navigator and helping to fly around those obstacles. Now, we really have a 5-part series when we're doing our Shark Tank deal, because it's a pretty robust program that we do, and we do these presentations everywhere. So today we're just going to go over the overview about what is it that your financials should be telling you, right? What should you be getting out of your income statement, balance sheet, statement of cash flows, and things of that nature? Just the high level stuff. Then in our series number 2, which is the 3rd Friday in October, that one we're going to dive deep into your income statement. And then in November, we're going to dive deep into your balance sheet. December, the deep dive is going to be in your statement of cash flows. And then finally, we end it in January with a deep dive into how do you really create meaningful metrics, KPIs that people own and change and implement. That's really key. So here's an interesting question. I fortunately or unfortunately do a lot of presentations with CEOs. Fortunate for me, because I love to do that. Unfortunate for them, because they have to be in my audience. But one of the questions I ask is like, okay, when you get your financials, I want you to tell me the first 3 things that you look at and what you focus on. And here's the answer that I almost always get. Revenue, income or EBITDA, and my cash balance. Now, what's interesting on that is twofold. Some of them get into margin. Some of them will talk about, their cash conversion, but very few. These are the top three. So what's interesting about these top three is if you look at these top three as a standalone single data point each month, you are truly looking at some of the worst factors for understanding how your business is really performing. In fact, these factors frequently lead to really bad decisions. Revenue, monitoring revenue, making decisions just on revenue can be horrible. Making decisions just on your cash balance without understanding how your cash is generated, it too can be horrible. Oh, I'm going to do all these new initiatives because I have $500,000 in the bank. That tells you nothing about the utilization of that. So literally they're looking at these three. But why else do they look at these three? So conceptually, 80% of y'all are looking at the wrong metrics. So why is that? Why is that? Too frequently, it's because of this human being. This is not a good representation of a controller, so forgive me for all the controllers that are out there. But what it does speak to is sometimes the people that are producing the numbers don't know how the users of the numbers are using the numbers. For example, we had this one client one time, really smart controller, really smart CEO. And at close each month, what would happen is the controller, it says, you know what, I'm done. Here's the numbers and everything else. And she worked remotely. And so she would send a big file to the CEO to print out on the CEO's desk. And out would come a stack of paper like a 1/4 inch, 1/2 inch thick. And I don't know about y'all, I'm already busy enough. And I'm pretty sure 80, 90% of CEOs are busy enough. So when you get a 1/4 inch stack of paper that's supposed to be your financials, there is no way you are going to digest it. And so when it's like, oh my gosh, how do I cut through this? And they immediately go to, I want to know my revenue, I want to know my income, I want to know my cash balances because I don't have time to digest all that. So that's where it's very important to start understanding it's not how much data you get, it's how much information you get. And there's a huge difference between data and information. Data is just sitting there. It's a bunch of raw stack of numbers. Information is meaningful to the users of that information to make a different decision, to know if they're on track, off track, healthy, sick, strategies are working, strategies are not working. That's how the information should be used. So let's go over the three statements because I want you to have a good understanding about what is really the purpose of these statements. So number one, your income statement, it's really your speedometer. How fast are you going? That's really all it tells you. You're moving at the speed of light, you're moving like a turtle, things are progressing towards your expectations or plans, or they're not progressing towards your expectations or plans. And it's particularly difficult if you're only looking at the revenue and net income. Your balance sheet, wow. For people that are accountants and bankers and things like that, they will tell you that the balance sheet for them might be the most important thing. Literally, I can look at your balance sheet and tell you more about your company than I can from the income statement. It's just that powerful. I will know the health of your company according to its balance sheet. And that's why I say, your balance sheet, is the body healthy? Can the body stay in the race? So it's also that thing about if your speedometer income statement says you're going 100 miles an hour, your balance sheet is going to tell you how long you can maintain that pace at 100 miles an hour, or you're going to crash because you're running out of gas. Gas in this case is always liquidity and cash. Just know that those two are interchangeable. The last thing is the statement of cash flow. Now, if I was to ask y'all to raise your hand right now and says, hey, how many of y'all really look at your statement of cash flow? How many of y'all really understand your statement of cash flow? And I'll tell you, it is one of the most important, underutilized, never seen reports in the world. In fact, for another client, I get to stand on one of their committees to assess their vendors. What is the financial health of their vendors? And I will ask for a complete set of financials. Almost universally, I have to clarify my request that says, oh no, I also want your statement of cash flows. because it tells me so much about the movement of money in your business. Now, if you step back from your business and you're thinking about your balance sheet and your statement of cash flows, I want to give you a universal view of those things. And we talked about this a little bit in the accounting wellness. So cash in your balance sheet and your income statement. So just know that the first thing that a business does, I put cash in the bank and I have equity in my company. What's the very last thing that your company does? You take all the cash out of the bank and you take all the equity to zero. Everything in between those 2 points is something moving towards cash. Your balance sheet is always moving towards or away from cash. And you need to understand that. And we'll get into that when we get into the balance sheet. So let's talk about how your income statement really works. So when you talk about your income statement, and you're talking about, hey, I have my revenue and I have my EBITDA. Effectively, you are looking at the top and bottom slices of bread on a sandwich. Yep, that's it. So how many of y'all go to your local Jimmy John's or whatever, and you just buy the 2 pieces of bread and call that a sandwich? Nope. Nope. If I go to Jersey Mike's, I'm going to get a 13 because I like all the stuff that's in between the sandwich, the pieces of bread. The same thing is true with your income statement. The things that make it interesting, the things that make it good, the things that you really need to understand are all the stuff in between the 2 slices of bread. And if you're not understanding the relationships of what those things are telling you, you're going to miss out on great information that your people should own in achieving your objectives, because the ownership of those numbers are all the tomatoes, lettuce, cheese, and everything else that's in between. That's where ownership comes. Without that ownership, you're just kind of hoping about the revenue and you're hoping about the EBITDA. So ultimately, we're really going to explore those relationships between those data points when we get into the income statement in our second series. Now let's talk about the balance sheet a little bit. Your balance sheet, it's like this. How healthy is your body? How long can you stay in the race? So for some of y'all that have known me for a long time, I used to run marathons. And if you know me now, you clearly know that I don't run marathons anymore. But this is the greatest analogy in the world, because if your body is in good condition, and if your body is well fueled, and if you take care of your body during the race, you can maintain that pace. But just like the guy on the left is, if you take off at too fast of a speed, and if you haven't fueled up, and if you don't take care of your body during the race, you will crash. And in fact, the first marathon that I ever ran, it was the White Rock Marathon here in Dallas. And there's this big hill coming up towards the last 6 miles, cleared that hill, coming down the hill. I was Superman and bulletproof. And I went from bulletproof, and about 100 yards later, I could barely walk, because it's that metaphor of hitting the wall. So your balance sheet is where you will hit the wall. Without a good, strong balance sheet, without good, strong liquidity to fund your business, even a successful business will have its lug nuts come off, the wheels will go spinning out of control, and your tanker full of gas will go flipping down the highway. And I'm not kidding. So what else does your balance sheet tell you? Well, one of the important things that it'll tell you is how fast you can go. Because if you outgrow the capital structure in your balance sheet, I will guarantee you that no matter how good your sales manager is, your sales people are, you will ultimately crash back down to the same level that your balance sheet will support. And why is that? Well, here's the interesting part. If you outrun your balance sheet, invariably what happens is you start running out of cash. And when you run out of cash, you start moving all the chairs around the decks. Oh, we got to call the customer. Oh, I got to delay this. I got to do this and this and this, trying to make cash work because you're growing too fast, right? And what happens is your business, your vendors start shutting you down. You need to pay in advance now because they won't release goods. Oh, you're now having to call your customers every week asking for money. And when those things happen, you know what you're signaling to everybody else in the deal? My company's not operating well, and I need to squeeze you. Is that really a message that you want out in your marketplace? I doubt it. For example, we had another client at one point in time, and I love sales and I love a good sales manager, but that doesn't mean I love all sales managers. So this guy was, he had a tendency to promise the moon and deliver a moon rock. So we were having these conversations, and it was about November, and he was telling me, we are going to grow revenue like 75%. It's going to be the most killer year ever. The backlog didn't show that at all. I mean, we were 2 months away from starting January, and it just didn't show that. And I said, you know what? That's fantastic. And I looked over to the owner and says, hey, look, do you have $750,000 you can put in the company? He says, what are you talking about? I go, are you okay with borrowing $750,000? It's like, what? I don't like debt. In fact, I hate debt. And I certainly didn't start this business to put money into it. And they're like, well, the only way that you're going to grow by 75%, math kind of worked out just oddly, is you need to invest another $750,000 in your bank, or else you're not going to make that growth. And so what we then talked about is there's a different way of doing that. So perhaps instead of growing 75%, we grow 35%, but we raise our margins 10%, our pricing 10%. So when you do those kinds of things, you end up extracting more resources out of every sales dollar that you have, and you start building the resources that help you sustain growth, that help you put more fuel in that balance sheet. Because your entire health is dependent upon the fuel that's coming out of your balance sheet. When we do the balance sheet in greater detail, we will also tell you about how it works and where's the junk in your balance sheet. Because the balance sheet's not very well understood by most CEOs, it's also where most of the trash is. And I will guarantee you that if you don't have somebody critically reviewing your balance sheet, the odds of there being trash in there is almost 100%, almost 100%. As part of our services, just as a FYI, we do a lot of cleanup and catch up for people that, for whatever reason, their books have gotten way off. You know how many times that there's a positive result out of cleaning up somebody's books? Zero. It's never happened. You don't find bits of gold in an old balance sheet that has been ignored or neglected. And here's why. Typically, your CEO is a very strong-willed individual, right? Very strong-willed. Typically, your bookkeeper or accountant is they are compliance oriented. They want to serve. They don't want to be in a knife fight. They're not going to stand their ground with the CEO and says, you are full of bunk. And that's not how the world works. So when bad news appears on the income statement, what usually happens is, oh, that's not the results. I know our results are much better. And what happened here? Oh, that can't be right. You need to make that go away. All that, make that go away. Boom, on the balance sheet. The balance sheet ends up being filled with trash. You could see it in sometimes prepaid assets that haven't moved in a while, investments that haven't changed in a long time, debt assets that are still on the balance sheet that should have been written off years ago. All those things create problems because you have a strong personality that is not listening to a softer personality. And quite frankly, a lot of times the softer personality is using jargon that this strong personality doesn't understand at all. So be very sensitive to your balance sheet. And when we get there, we're going to go through processes about what to look for and what to really question. That's very important. You don't have to know what those accounts are, but you need to know if those accounts are a problem or not. And that's where everything moving back and forth to cash is really important. For example, if you see a prepaid income or a prepaid expense item, and it's the exact same balance month after month after month, I will guarantee you have a problem. And not only do you have a problem on your balance sheet, but you have also highly likely overstated your income. So that whole thing about I like to see my net income, I like to see my EBITDA, in that situation, when you have those stuck balances in your balance sheet, I will guarantee you that your income statement is not correct. And that's also a universal rule. If your balance sheet is right, then your income statement is right. It just may not be in the right place in the income statement, but the income statement's right. If your balance sheet is wrong and is neglected, the only thing I can guarantee you absolutely is your income statement is wrong. So if you're looking at your revenue and your net income and you think you're happy on that, you're ignoring your balance sheet, just know you're at risk because there's almost 100% probability that your underserved balance sheet is lying to you, is giving you false positives showing up in your income statement. So step back from that because there's nothing more dangerous in the world than a false sense of positives or false positives in your decision making. So let's kind of go over the overview of how I think your financials should be organized. This is the general picture that I would paint. So I will contrast this to what I see all the time, but your financial statements, they should look a lot like an iceberg. I know that's really weird. But what is the universal truth of an iceberg? Well, 10% of it is showing above the water and 90% of it is below the water that you can't see. Same thing with your financial statements. Your financial statements should give you just the top of the iceberg data points, but in a way that you know that things are working or not working. The relationships are on track or not off track. In fact, that upper 10% of your iceberg should tell you not only what's not working, but will tell you where to dive underneath the water to go find out where the problem is. Because if any entrepreneur had to swim around that entire iceberg every month to understand their financials, there's no way they would get through it. They're back to having a 1/4 inch thick stack of paper they're trying to digest every month. Not going to happen. So organization of your financials is really key. What's interesting is I sometimes when I'm with our clients, our new clients, I sometimes surprise them. And there's a couple of clients on this call, and they could probably raise their hands like, oh yeah. But I will tell you universally, when I get your financials, the first thing I say is, I don't like your chart of accounts. It's not organized well. It doesn't help you see relationships in your financials. And seeing those relationships and how they're interconnected is excruciatingly important. So here's some real life examples. I will get, golly, somebody's chart of accounts, and it's 500 or 600 lines long for a modest sized business. And all I can tell you is that's way too long and way too in depth. The other thing that I will see is I actually had a new client, and they had bought a business, and it was a mess. They kind of knew it was a mess. And when we got there, their balance sheet was 37 pages long. Now, if I'm hearing a little bit of background noise, so I'm not sure if that's me or whatever, but hopefully that's not disturbing y'all. But with that, 37 pages long, all that says is it is absolutely impossible to understand what's going on with your business. So when I get there, I will reorganize your chart of accounts so that it starts to get into clusters of different costs and clusters of different assets so that I can constantly see the relationship between these things, because these things should be moving together or moving apart almost universally. Now, for me, it's easy for me to see relationships. For you, maybe, maybe not. But that's where the organization of your balance sheet and income statement is even more important. Because when you collapse it down or expand it out, you should be able to readily see certain relationships. And in seeing those relationships, the most important thing is, one, you're going to create metrics. And metrics are not just within the income statement or just within the balance sheet. Sometimes those metrics are connected from one to the other. But if your data is not organized, it's really hard to make for meaningful metrics. In fact, the number one reason why accountants get blown up in front of their leadership team is they will put up a big screen of numbers, and somebody will ask a question about some idiosyncratic deal that's sitting up there on the screen, and the person goes, well, I don't know, or they'll see some weird relationships, and it's like I don't know, because they're trying to manage too many lines. And I don't know is the biggest credibility killer that any accountant or CFO can have in front of the leadership team. So organizing it better allows it to communicate better, allows people to own the numbers better, and allows the impacts to be disseminated throughout the organization and not just sitting on the CFO's desk. So if you ever want to change your numbers, I will guarantee you, it's like the old adage of who really makes you money in your company. Well, it's sales and operations and product execution. You know, it's never the answer. Your accountants. Because the only way your accountant can make you money is maybe helping you with better decision. That's certainly the deal. Or your CFO really helping you with other decisions. But I used to joke around with some of my clients. Is like, we're only a credit entry away from outstanding income. Doesn't help you very much because it jacks up your financials, but that's how an accountant can make you money. So we're going to start out just real simple in how we start looking at your income statement, right? So an adage that I have is that your income statement should be organized in a way to help you make sure you know what decisions need to be made and who owns those decisions. So when you start looking at your income statement next time, I want you to visualize, does my income statement look like a decision tree? Right, let that sink in. Does it look like a decision tree? Does that 10% on top help me to understand the 90% down below? So if we explored that a little bit further, and I know that this is reversed because I have gross profit over here, but gross profit is between revenue and COGS. And then we get into the mix of our revenue, the pricing of our revenue, how labor is performing, how products performing, and then the mix and the drivers on this. So you can see that in a horizontal way, we have our iceberg. If our gross profit is wrong, then is it the mix? Is it the pricing? Or did something jump out at us on COGS? Did labor get sideways? Did product get sideways? So these kind of if-then statements, these type of hierarchical structure or decision trees, that's how all your financials should be organized, especially your income statement. Especially your income statement. We actually take this model down through your operating expense of what people may refer to as SG&A. We will cluster your SG&A to be selling and marketing expenses, and I'm including commissions and salaries of your salespeople and marketing people. Why do I do that? Oh, let me finish how I organize the income statement. So of course we have the gross margins, but we have selling expenses, marketing and selling expenses. Then we have all other headcount and administrative employment costs, so salaries, benefits, and everything else. And then we have discretionary expenses. And then lastly, we're going to have all your fixed expenses. So let's talk about why we organize it like that. Well, number one, I want to see how productive and what is the ROI on all my marketing and sales efforts. There's a certain percent that should be relative to my revenue. And if that percent gets to be too high, it means that my people are being unproductive in their business development. It also allows me to readily calculate something you hear a lot about, our customer acquisition costs. So clustering these things helps to easily either have awareness on something simple like my sales as a percent, my sales expenses as a percent of my revenue, or in developing really powerful KPIs. I also put headcount and everything related to employment as a next group because that usually represents 60-something% of the total cost structure of most mid-market companies, unless they have heavy equipment or stuff like that. So if a CEO needs to make decisions about cost or to invest, it's going to be in that deal. So they need to be able to readily understand how those expenses are moving relative to their company. We had another client that we're helping them out with right now. And what we saw is a really healthy company last year, and they hired a bunch of people last year. And this year, their revenue has fallen off by 30%. So year over year, their revenue is down by 30%. But year over year, their headcount is up by 30%. That's not a good way to go because they were not paying the visibility between where can I move numbers around relative to what's happening on my top line. There's all kinds of examples we can go through. As we dive a little bit deeper into, and we're just going to go into the revenue piece about your income statement and how it's structured. So my universal rule is not all revenue is created equal. Nope. If you want to see companies that trade at a multiple of revenue, it's because of the quality of their revenue. You want to see companies that trade at some low multiple of their EBITDA, it's because they have low quality revenue, right? So the two most obvious situations in which this happens are really a SaaS business, right? To where it almost 100% of their business is the revenue. It's fantastic. And why is that revenue so valuable? It's because it is repeatable, sustainable. It's probably contractual, which means that last year's revenue will probably still be there next year, the year after that, and everything else. So when you reduce the risk of revenue, of having it repeat, you increase the value of the company profoundly. Back in the day, I owned a construction company. So in construction, I'm putting out bids. I'm trying to win bids. The same GC is getting bids from 5, 6, 7 other subcontractors just like me. So every year, I don't have business that just continues on forever. I have to recreate my revenue every year. So instead of your SaaS business selling at a 20 multiple to EBITDA, your average construction business will sell for maybe 2 or 3 times EBITDA. And if you're a general contractor, most of those people just sell for book value, because the value of their revenue is so radically different. So let me ask you this. Now that we've talked about the qualitative nature of revenue, can you see that on your income statement? Does it pop out to you? It should scream at you about, are you accelerating your high value revenue, or are you living on your low value revenue? Also, what creates value in revenue is lumpiness. I could have had a business that, 2 businesses that do $7 million a year do not have the equal value. If one of them has a lot of lumpy revenue and the other one has consistent, and if I said 12 million, so let's do that because that math is a lot easier. 2 businesses have 12 million and one's doing consistently $1 million a month, and the one does 2 million, then 200,000, and 2 million, then 100,000. Those businesses have radically different values, because anybody wanting to buy the business wants to buy highly secured, repeatable cash flows. Lumpiness is equal to risk. Risk is equal to a downward push on your price. But on the face of your income statement, hopefully you can see your high value revenues from your low value revenues. So let's go back to my construction company. What we would literally have is, total revenues, got it. But then we would have project and construction revenues. We would have maintenance revenues, and then we'd have service revenues. Why did we break those out? Because those latter 2 are on contracts, annual contracts. They're not going anywhere. In fact, if those dip down, it's a huge red flag that something horribly is happening within my service level, because now I'm losing customers. So just on simply looking at your different revenue streams, you'll know the value of your company. So the one thing I love to throw out to people as far as their revenue is this picture. Which revenue stream? Oh, that's supposed to say your revenue. I'm sorry. I'll get this thing corrected. But let's say that this is your revenue. Which one of these 2 revenue streams would you want? You want a big pile of gravel, or you want a handful of diamonds? Okay. Well, if my wife is on this call, I know she wants a handful of diamonds and not a big pile of gravel. What's also unique is there's a whole bunch of equipment needed to move that gravel around. That's pretty typical of low value revenues. So if I'm back in my GC world or my construction world and I'm doing road construction, why have millions and millions and millions of dollars of equipment that, if it's not fully utilized, it's sitting there idle and costing me a fortune? But for this diamond, I need a good security system and one heck of a safe, and I'm okay. And I just open up the safe the next day, put it back into the display counters, and hope nobody comes in with that grab and smash thing that's been going on. But I hope this makes sense as far as just where the basics of your balance sheet and income statement really start to make sense. And with that, I'm going to open this up. I know we're just going through the basics, because if I went real deep in all this stuff, we would be here for hours. Now, I would have a great time, because I love to talk about this stuff, but I'm pretty sure I'd lose about half of y'all, or if not 2/3, if we did it all at once. So with that, any questions that y'all have regarding how you use your financials, what you understand or don't understand, just throw it out there, and hopefully some of this has made sense. And y'all can all unmute yourself. If I need to unmute you, just let me know that, and we'll do that. I will look at the comments and see if there's some good comments there. Oh, Lola says she's yes there, that she is here, and that's wonderful to know. I'm sure I'll get some good feedback that way. Uh, oh, Tiffany's, John. Yeah, we'd much rather be at Tiffany's than we would my construction yard. You're absolutely right, sir. I always love it when I see John's name pop up as one of my attendees because there's always going to be a good question. Lola, can you let me know if people can unmute themselves? Because I certainly want that to be able to happen.
Yeah, they can.
Okay, just want to make sure.
Hey, Bert.
Yeah.
Yeah, this is Michael Byzantine. How you doing? Hey,
Michael,
I had a question. A lot of times, obviously there's the linkage between the three and how they really tie together. Can you touch base on kind of, you don't want to detail, but I love how they do work together, as you know, almost they feed one another. But how does the linkages and the importance when, as you kind of mentioned, looking at all three and not just either one or two, and kind of how that ties together?
That's a great question, Michael. The linkages are very powerful. Like if I'm going to look at my balance sheet, I really want to look at my working capital, which is all the current assets and current liabilities. Because if those things are jacked up, that's immediately something that's just jacked up on my income statement, right? And then this is where KPIs and metrics are hugely valuable. So if I looked at my AR and let's say that it was 1.2 million last month and it's $1 million this month, is that good or bad? Maybe. It's certainly lower, but it's only a good number if my revenue stayed the same. That means I'm collecting faster. But if my revenue dropped more than the 20% that my AR did, then that drop is a bad number. It's also bad if my AR goes up. Let's say it was $1 million and now it's 1.2, right? But my revenue stayed the same. That's telling me that I'm not collecting nearly as fast. So when you start to see those relationships, that one number becomes meaningful because of what's going on in the income statement, AR is probably the easiest one to understand that, guy. Then you can start leaning and going, what's wrong with our billing process or our collection process? Did that make sense, Michael?
Yes. Thank you. Helpful.
Yeah. And another one, Michael, that comes to mind is prepaids. Prepaids are cash that's out the door and it just hadn't hit your income statement. So when you're looking at prepaids, it hasn't hit your income statement, but it has gone out the door. And knowing this on your balance sheet has not hit your income statement, that's where you look down into your statement of cash flows, and that bad boy is going to pop out right there. A lot of times we will get with entrepreneurs and they go, I made a ton of money last month and I have like zero cash. Well, the problem is you don't understand your balance sheet. And then the answer is in your statement of cash flows because it's organized to where it starts out with net income. And this can tell you where your working capital ate up your cash or delivered a whole bunch of cash over and above your income statement. That's a really good source to start. So if you're looking at your income statement and you're wondering, where did my cash go? Then go look at your statement of cash flows and it'll tell you what part of your balance sheet changed and ate your cash. Hopefully that made sense too, Michael.
Yeah, no, that was good. And I love that you kind of had a telltale sign of like, hey, here's a little telltale you can look into it. And that's helpful for clients and for even just personally. Yeah, thank you.
It's also interesting about prepaid. We look at that and we think it's, more assets. Your banker looks at it and goes, dead assets. So assets are either getting ready to generate income, AR, inventory, or they reflect the consumption of cash already, prepaids, investments, debt assets. So when you look at that, I will guarantee your banker, or God forbid, goodwill, your banker is going to look at your balance sheet and go, not really a good asset, not really a good asset, not really a good asset. And they're going to take your net worth, your net equity, and they're going to deduct those items from your net equity because what they want to see is what is your net equity of cash producing assets, not of debt assets and not of spent assets. Hopefully that made sense too, because sometimes when you allow trash to accumulate on your balance sheet, you're inflating your balance sheet only for your own views because your banker doesn't see it that way at all. And if you think you have a healthy balance sheet and your banker said no, it's either your cash flow or trash in your balance sheet. What else?
Well, and Bert, I think, this changes from company to company and industry to industry. Like, a SaaS balance sheet isn't going to look the same as a GC balance sheet, right?
Oh, great point.
But in both cases, I don't know, um, it's actually a sign of health if the balance sheet is skinnier.
Oh yeah.
If you don't have as much tied up in AR, if you don't have as much tied up in inventory, if you are able to use your equipment more efficiently, um, I know that's a little contrarian, but AR is just a step away from cash, right?
Oh
So,
yeah.
you know,
And John, that's where I love the metric of days of sales outstanding,
yeah,
because it is a huge, it makes it 100% related to my revenue.
mhm,
So I know it's a relative measure. And then I know immediately when I start having problems, like if it gets over 35 or 40, it's like, something's not going on well here.
yeah,
Uh, Same thing is true with inventory. And especially on inventory days in inventory. And people don't think about this. I like to know what is the aging of my inventory. How much stuff do I have that's been here over 6 months? Because inventory to me is a write down waiting to happen. If it's not moving fast, your customers are telling you they don't want it.
yeah. And again, skinnier the better,
Yeah, yeah.
because what it's really saying, the skinnier your inventory, the better you're able to manage your inventory, the less cash you're having to invest in your inventory.
You know what? That is a great point. A great point. So we kind of get into this whole cash to cash cycle, which we'll talk about later on. But just as an example, somebody I was talking to, this young lady, and she was responsible for billings and collections, and another guy in the same company was responsible for inventory. And I was saying, well, your AR is way too high. Your inventory is way too high. And they're like, well, what does it matter? I mean, we're going to collect it sometime. What does it matter? We're going to sell the inventory sometime. And so here's where it matters. So let's say instead of 1 month of AR, and that's the only asset you have 3 months of AR. So 3 months of revenue. So that same company that had revenue of $1 million a month, instead of having $1 million of AR, they had $3 million of AR. You know what that means? They have to have enough capital to run their business for 3 months and not 1 month. So the more you can compress this cash to cash cycle and managing how your AR goes, how your inventory goes, means that you need less capital to run your business, which means that you have less financial stress to make sure everything works well. Very, very important. What else do we have?
There's a text in the group chat. Is there a guide to quality of earnings between different types of companies?
Dave, that's a great question, and you probably already know that answer. There are some really good guides for quality of earnings. And when I say quality of earnings, I don't want that to be tied to Q of E, because Q of E is a term that's used in a buy-sell kind of arrangement, quality of earnings, and that's more of an audit. One thing that we do on that regard, Dave, is we have a huge database of benchmark studies on different industries and everything else. And what we will look for there, and keep in mind that when we get our benchmarks, they're reporting average for that industry and the participants that are in it. So if we have a good benchmark and it's telling us what average is, then we're really going to start looking at, are we above average? Let's understand why. Are we below average? And let's understand why. Because it's usually the qualitative nature of both revenues and execution. So that for me is where I typically go as a qualitative nature. I usually don't like low income deals because the risk on that. But Dave, did that answer your question?
Yeah, that's great. I appreciate it.
Yeah. And if any of y'all want to know what your benchmarks look like, send us a request. Let us know what that is. I'd be happy to let you know what a couple measures, what your EBITDA percent is, what your gross margin percent is, and maybe the most important metric out of a benchmark is what is your revenue per head? Mm, 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 mm. It's absolutely one of my favorites because it ties your revenue to the biggest, most fluid part of your cost structure. John was also talking about equipment utilization, and there's things like asset turnover, et cetera, et cetera. What we've done in the past is we show a couple of trend analysis. Trends are fantastic ways of understanding your business. And what we trended was the total investment in assets of equipment and everything else, because this is that road construction relative to the revenue. And we had been leaning in on the company pretty hard, going, we think you have huge utilization issues on your assets. And we changed how they accounted for their deals to where they charged the jobs based on a day rate versus just allocating. Because as soon as you allocated it, it became a socialist deal and everybody's paying the same whether they use it or not. But as soon as they started doing it on a day rate, utilization went through the roof because those project managers handed the equipment back. And you could see that they had, at that point in time, they had $5 to $6 million of net fixed assets, net of depreciation, and they were doing $3 million a month in revenue. But as soon as they started really pick up the revenue, but their assets didn't change at all, and their revenues caught up to where it was about $5 million a month in revenue, still on the same level of asset base. That alone created $1 million a year plus of additional EBITDA because of how it drove utilization, and even more than that, because it saved them millions of dollars of capital expenses. They were able to curtail capital expenses for 2 years straight. Anything else for anybody? I surprisingly have not used up all my talking time, which is unusual for me because I'm usually pretty good about sucking up airtime. Anything else before we all go away and have a great Friday?
Yeah, Burt. Hey, one more question.
Yeah, Michael.
What do you typically try to? And I know this is a hard question, but for CEOs that don't know a lot about their financials, but they want to understand the basics, and they have a pretty good controller, or let's say a good controller or a good CFO, so they got the details. Are there kind of areas that you say, hey, focus on this? Or, kind of how do you coach those that literally you're right, they're starting kind of with like, yeah, I know my business, I understand a little bit, but where do you kind of have them start off?
I'm going to answer that as a two-part answer, and I apologize for that. It's a great question, Michael, so thank you very much. Number one is I want to know who's in the room. Who's in the room that these numbers are being presented to? So let's say that we have a manufacturing concern. I'd love it if the COO or head of production's in the room. I'd love it that the head of sales and marketing is in the room, because then I can simplify the numbers to make sure that I have numbers that are uniquely targeted to the COO or head of production's job. I have numbers that are uniquely targeted to the head of sales and marketing. Probably the biggest things that I will have somebody focus on their income statement, just off the bat as a starting point, I'm going to look at your gross margin real hard, because people become enamored with the size of their revenue, and I don't give a flip about the size of your revenue. I care a lot about the size of your margin, right? A healthy margin does a lot of things as far as increasing the growth of it. The other thing that I'll throw out there is revenue per head. Lastly, I will throw out, I love on the income statement, revenue per direct labor head, because that is a quick way of seeing the utilization of my labor. And then gross margin as a percent, not as a percent, per administrative head, because that tells me I should be able to scale my accounting department. Just because I double in size doesn't mean I need twice as many accountants. So those things are very important about how are we harvesting those things, but margin is crazy important. Here's another thing about margin and simplicity of looking at your income statement. If your margin percent jumps wildly month to month to month to month, it's a problem. It's a big problem. And what it's telling you is one of three things. Number one, you're not doing a good job at pricing your goods and services, especially if you're in a project-based system. You're doing a really bad job. Number two, you are not executing well. If they're jumping all over the place, you are not executing well. Number three is your accounting is wildly disconnected from what's actually going on in the company. And that's bad, because when those things spike, and collapse, I have a false positive. Then I have a false negative. I have a false positive and a false negative. You can't make good decisions that way. Does that make sense?
Yeah, no, and I liked it. And you even indicated it's something I can ask as a tell on. You talked a little bit about looking at trend. What do you recommend as a good trend to look at? As far, you do 3 months, is it 6 months? I mean, is there something that, or is it vary by industry? And I know it's a broad question, but would like to get your take.
Well, like if I showed you 10 of our clients, each one's going to have, oh gosh, half of them or all of them are going to have half of our standard KPIs. Others are going to be very industry specific. A service company is wildly different than a construction company. People that have backlogs have different metrics. So let's say you're in construction again, because I happen to like construction. One of my favorite metrics in the world is number of months of revenue in your backlog, because that tells me about how much assurance I have of my future revenue. So like in my construction company, I always wanted to have 4 months of revenue in my backlog. If it went below 3, I got really nervous. And why was 4 months important? Because my sales cycle was 3 to 3.5 months. So at 4 months, I always had assurance that I could probably keep the wheel spinning. But if it got below 3.5 or 3, I'm changing my pricing on deals because I need revenue in here to keep people fed. So it's a little bit of a what if. My last closing comment on margin is this. Margin is also a wild indicator of a great culture. You want to have a really good culture that's not authoritative or autocratic, have fat margins. And why is that? If you have really skinny margins, you have very little breathing room for when you stub your toe and it puts the company in hurt. Therefore, to control that, you have to become more and more autocratic to control everything. If you have nice fat margins, well, you stub your toe, that's a learning event that you learn from and avoid in the future. But boy, skinny margins, man, that's a tough environment to be in because everybody's on edge and has to do it perfect. What else?
Well, I'm just one man, but I really like the way that you organize the P&L, especially the SG&A. Breaking it into the sales, breaking it into the fixed versus variable. I mean, in the span of a few lines of P&L, you're really providing a great deal of information that, especially when you start doing the trend analysis, stuff can come off the page much more quickly the way you've set it up.
And going into Michael's deal, I would always trend out the percent of sales and marketing is a percent of my revenue, right? I hope to get more and more leverage, and especially if I have a business where I sell it once and I can harvest it for a while, then that should be coasting downward or even flat. But if it's flat, then my revenue should be accelerating wildly. So it depends. But we spend a great deal of time when we first get engaged of really peeling the onion back about what metrics are meaningful to change behaviors. Because again, we cluster things on your income statement like John described because it's decision blocks. That's where blocks of decisions can be made. We also cluster it so we can create trends that help people understand. So Michael, one thing that we have found in doing some research on the topic, and I think it's close to 80% of CEOs are visual or tactile learners, which means that they're not really good of seeing a huge stack of numbers in spreadsheets and seeing the pictures that's really telling them. Now, I know John well, he's a very experienced CFO, but a good CFO, they can look at those spreadsheets and see all kinds of stuff. It's like, oh, and tell them pictures. So what we do, and we'll get into this last module, the fifth one about metrics and everything else, we convert 100% of your financials primarily into metrics, KPIs, trends, and everything else. And we will start our presentation going over those and then go into the income statement. It's much easier to see where the red alerts are that way. And what's really interesting, Michael, when we get to this part, so please come back for part number 5, we will show you how when you look at trends and KPIs, you can not only identify problems, you will be able to identify when your people's processes, systems, or behaviors have changed. When you see these trends and you see them in a steady relationship and then they break that relationship, I will guarantee you right there, somebody's behavior, decisions, processes, or system changed. And when done well, and you have these kinds of trends analysis that you're going over with your leadership group, you just step back and say, what happened right there? Is it a one-time event or is it ongoing? And then ask yourself, if you want to get down to root cause real fast, just ask yourself, was that caused by a person, a decision, a behavior, a process, or a system? Simplify that a little bit more. Was it a person, process, or system? And you will get the root cause so fast it's unreal, but only if you can identify it quickly. Okay, now I've used up all of our time. So thanks for the free air. If y'all have any questions whatsoever, here's my contact information. Feel free to send me a ping, ask me anything, or you can set up like 30 minutes to go over your individual situations. No harm, no foul. We love to do that. Thanks again for spending your Friday with us, and I hope y'all have a fabulous weekend. Take care.
Thank you, Burt.
Thank you.